Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, May 5th, 2022. It is 11:10 a.m. Eastern Time, and this is what I consider day 5 of what I've dubbed D Week. D Week is, I did the video on Friday telling you it was D Day, but really saying it won't be just today. I said just like the invasion of Normandy, it wasn't we didn't take the beaches. The Allies did not take the beaches in one day. D Day was the day they landed. It took a few days to take all, what was it, 4 or 5 beaches, and then it was a successful invasion. So I dubbed it that and said it would probably carry into this week because we had the big market moving FOMC meeting. Of course, it started on Friday because that was the last of the two big fangs and the two biggest companies out there, Apple, the world's largest, and of course Amazon, both reported. So the market had been waiting to see how they report, and as I always say, it takes a few days for the market to digest what they say, what they report, what their guidance is. Never ever go off the initial reaction, because that often is not the lasting reaction that sticks. So therefore, the markets now had several days, and we're fresh off the heels of the FOMC meeting. And so what I'm going to do is go over an analog that I came across last night. I have to say, over the years, I've seen quite a few. But this one, for many reasons, the reasons I'm going to discuss, to me is almost uncanny. Um, so just to start out here, what's going on today? Just a quick update. Last night I gave you guys subscribers a short entry here. Mentioned that I reversed my longs to a short at the highs. Yes, what proved to be the highs at that resistance. Nice resistance in 329.80, and right there in QQQ you had very nice, clean, distinct highs, and so far so good, and actually exceeded my that pullback target I had shown in the arrows of 322.91. But we hit that big level that I also had here. Let me show you that. Okay, that was this post here in the SPY QQQ at resistance, and we had the you can see the 322.91, but the 318 has always been an even bigger, much bigger level, and we just hit that. So good time if you took that short yesterday, or you want to be in longs to reverse, go back long. 318 is big support. Why is it big support? It was the major double bottom low, and then we had a triple bottom low here. Then we had the false breakdown that was preceding the FOMC meeting. Again, never ever take a breakout or breakdown, or at least take them with a huge grain of salt if they occur. The breakouts occur before a market moving FOMC meeting, or before big market moving reports like Apple, Amazon. Ford's not going to move the market anymore. It used to back in the day. General Motors, they don't move the market anymore. The things that move the market now, of course, the biggest weighted component, Apple. And it's not just because Apple's a widely held stock, and a lot of people have iPhones. It has nothing to do with it. It's the fact that the S&P 500, the Nasdaq 100 are cap weighted indexes, and Apple, being the largest company in the world at $2.6 trillion, has the highest weighting by far in the Nasdaq 100. And it's also the highest weighted component of the S&P 500. So it's simple mathematics, and that's why you again need to see where those guys are going to go. So back to my D-Day thing, and I'm talking about a battle between the bulls and the bears, battle for major support that I think have taken out with conviction. Again, barring any whipsaws, is going to determine the next major trend, and if successfully defended, then the bulls take the ball and run. They win this battle right here, and at least for the near term, that puts the odds in their favor, and we could see some more upside. And again, I've made it clear that I think at best it's going to be probably just a test of a rally up. We could test come back and test the 200-day moving averages again. There's just a tremendous amount of overhead resistance. So again, I don't want to recap. This is all stuff I've covered ad nauseum recently, including this week. So let's jump into my analogy of what's going on here. What we're going to be looking at, I may jump back to this chart here, but we're going to be looking at some different charts with white backgrounds, and I'm going to focus on the action of the markets, and my go-to trading index, the Nasdaq 100. simply for the reasons I've said many times. If you get the call, you're either going to be right or wrong on the call in the stock market. And so therefore, why trade the S&P 500? Because if you're right on a rally, the Nasdaq 100 at almost all points in time is going to go up more than the S&P 500 during a bull trend, a bull market, bull run, or even a bear market rally. And likewise, if you're correct, in a bear market, it usually falls more. And it's just because it's higher beta, it's more concentration of tech stocks, and it lacks a lot of sectors and a lot of defensive issues and high dividend paying stocks like the S&P 500, which is what keeps volatility lower in the S&P 500. So we're going to focus on the year or so leading up to this high, which I still maintain and haven't wavered on that I think that's a significant top. I think it's the end of a bull market, not a bull market like a lot of people might think. The media might consider this the last bear market when COVID hit and the S&P fell 36%, the Nasdaq 100 fell about 31 if I recall correctly. But that's an antiquated definition, and I've covered that many times. In this day and age with an extremely easy Fed, excessive monetary policy. This is the bull market. It started back here in 2008 and when the Nasdaq bottom, and then 2009 every other index bottom. This is my bull market uptrend line. And so every correction that we've had, even though there's been several, including this one here in 2015, this one here in 2018, and this one here in 2020, early 2020, those were all approximately or in excess of 20%, but they were just corrections, and they took us back. They were reversions to the mean. They took us back to or near either of these primary uptrend lines that I have. And so that's kind of the long-term outlook. And again, I maintain that this has the potential, only time will tell, to mark a major top. And if so, then this is not just a correction in an ongoing bull market. That's the million-dollar question. I can tell you right now, and I'm going to speak to that. This video may get a little bit long-winded, but bear with me. I really believe there's good stuff in this one. The vast majority of market pundits that I read about, listen to, believe that this is an adjustment period due to rising rates, and that the economy is still on strong footing, very strong footing, and the consumer's strong, and we're not about to head into a prolonged bear market or a significant bear market. And so I know there's quite a few looking for new highs, and again, that's where we differ. Let me jump into the comparisons. So let me grab that. It's going to be here. Okay, so we're going to start out. I realize that unless you're watching this video on a large monitor, which I'd always recommend versus a phone or a smaller PC or tablet, I'm going to zoom into these charts. I'm going to expand each one, but I want to show you. This is the comparison that we're looking at here. And what I'm looking at is the year leading up to the top. The market peaked in the last bear market. What I consider the last bear market was October of 2007. And that was about a 56% or so drop in both the Nasdaq 100 and S&P 500. That's one instance where the S&P fell as much as the tech-heavy Nasdaq, high-growth Nasdaq, and that's because the banking sector collapsed. It would have been poof, but the government bailed them out, as we all know, bailed out the big banks. But they were priced for death until that happened, with several big institutions failing. And one thing many people don't know, the Nasdaq 100 doesn't have any banks in it. It lacks a financial sector. If it is, it's negligible. It's less than 1%. So there's effectively no financials or banks in the Nasdaq 100. Again, as far as weightings go, and so that's why the S&P had such a drag down, because they were a big weighting back then. Okay, so here are the parallels. I'm going to just show you in this side by side so you can see. I zoomed in. This starts in October, the beginning of October 2006. Back then, the market peaked in October of 2007. So that's the year leading up to the top, right? Well, this time around, we peaked in November. Remember, to me, I haven't been shorting the S&P 500. That peaked in the end of December, early this year. I've been shorting this and persistently, I've been long throughout some of the big, most of the rallies. You know me, guys. Active trader. I've pointed out these divergent lows, breakout trading ops. But as far as longer term trend in positioning, persistently bearish and calling for more downside targets since the peak back here, and as we went on with a lot of short entries up, around that high point there. So okay, so we're going off that. We're just going to work with my theory now, whether you agree with it or not. That was the top right here back in 2000 in November, I should say, of last year, this time around, and this is the comparable top in 2007 October. And just like then, look what we had. We had a divergent high with a pretty good correction. It took us back to those key 200-day moving averages I always talk about. The red line is the 200-day exponential, and the blue line is the 200-day simple. We had divergent high 1, pretty good correction. Divergent high 2, pretty good correction. Once again, tested both the 200-day moving averages. One final thrust, looks to me like a blow off top, and that was also a divergent high. So the similarities to me are uncanny. Divergent high 1, 2, 3, each one followed by a correction. 1, 2, 3. Okay, so you say what you want, but you cannot argue that this hasn't played out. And I'm going to talk a little bit here in a second about using analogies and how it doesn't always play out that way. So we started that high. We had a nice correction, and it was a big drop. That is, let me see, I believe I measured the drop 20. It's hard for me to even see here. It's 25 or so percent. And this one on the Nasdaq 100 was 22. They're almost equal, guys. Very darn close, right? And so those are the drops. That one ended with a divergent low, positive divergence. You know me, I love my divergent highs and lows. These are my swing and even trend trading, especially when on the daily chart. That divergent low back then, which came in looks like early March, was good for about a 22-23% rally to the highs. This time around, we had the exact same thing. We had a big drop. We had positive divergence. I pointed out at the time, mentioned reversing, going long at the time, and we had a rally of about 17.5% or so right there. Okay, so again, you can say what you want, but you cannot argue or dispute the similarities there from a technical perspective. By the way, there are retracements. Again, I'm going to go over this on these charts. I'm going to zoom in here, but I can tell you they both retrace right about at the 61.8 Fibonacci retracement. That is a retracement of the entire move on the way down. That is what I've always said. My number, and it's most people's, if you use fibs, is between the 38.2, 50%, or up to the 61.8. That is what a typical counter trend rally will go. It'll retrace anywhere from about 38 to 62% of the previous move. Those are key Fibonacci levels, and that was it. Then we went down again, and now here's where I'm going to zoom in and show you, because what I wanted to talk about again, you might say, yeah, a lot of big coincidence, Randy, but this time is different. I'm going to talk about that real quick, and then we're going to expand each of these charts. Before I expand on the charts or go any further, let me just say this. No two tops or bottom in the market are exactly the same. It's just like relationships we have in life. Friends, lovers, children, siblings. You know that no two relationships that you've had in your life are exactly the same. There are similarities in some instances, but none are exactly the same. So I don't expect, well, who knows? Let's just take away, I'll give you some takeaways and what I think is actionable information from what I'm getting at here. Things to watch for that could very well determine who wins D-Day or D-Week, bulls or bears, and it might happen soon. So as I like to often say, history doesn't always repeat, but it often rhymes. Okay, so that's what we're looking at here. This is the basis of technical analysis, which is recognizing similar technical conditions and and patterns that have resulted in the past, and then what has happened after that. In other words, what happens after a head and shoulders topping pattern or a bullish falling wedge pattern. If you can recognize the patterns, and you look back in the past, and 8 times out of 10 those play out for a move. Once you get the breakout and the pattern triggers, well, that's what technical analysis is all about. So that's why I'm making this comparison between these two analogs. All right. And here's the other thing: as I get to the juice here, to the meat in the end, compare these two periods. Remember that big drops in the market come when the majority do not see it coming, and that is from rapid positioning unwinding. So where yesterday I told you guys, subscribers, that I pivoted once again based on the bullish action leading up to and immediately after the FOMC meeting, what I've seen in these charts puts me on guard or on standby, ready to pivot back once again very quickly, and that means to an aggressive short position from reversing back, covering a lot of those shorts and going into longs over the last day or so here, last couple of days. So that's one thing to keep in mind, that big drops come when the masses don't see it. And again, I don't watch a lot of TV, but when I turn it on, I've been doing more of it lately just to kind of get a pulse on what the talking heads are saying and what I read. And most don't believe that we're looking at a major bear market. Most believe this is an adjustment period, that the economy is on solid footing, and the consumer is holding up, and that's an important thing. The consumer spending is over two-thirds of GDP, and so here's the differences. So I'm showing you the analogs that I'm showing you is uncanny. It's almost scary how similar the technicals are up to this point right here. And remember, we're right here right now in the analog, not this part here. I'll get to that in 1 second. But here's what's different. Back then, we were in a financial crisis, at least, again, where I'm zooming in, not at the high there, but at this point in 2008. And by the way, this is where the bottom fell out of the market. So back then, we were in a financial crisis. The Fed was easing, and we had no to very little inflation. Now it's almost the opposite. We are in one of the strongest economies in history, really. Extremely strong economy, although albeit slowing. The indicators have been gradually rolling over lately. I've mentioned that, but let's just go with the fact the economy, again, by what most see out there, going off, is on strong footing. And you also have, unlike then, where you had a Fed easing, you have a Fed tightening, and we are in a very high inflationary environment. So the macro couldn't be any different then and now. So just keep that in mind. And then the other thing I'll say to that is, remember, the markets look ahead 6 to 9 months. So a rosy, strong economy today, a strong consumer. I've said this before. Consumer confidence will change on a dime. Consumer spending habits. You give the stock market another, the Nasdaq's already fallen over 20%. You take another 20% off the Nasdaq 100, where most people have their money in growth stocks, or the S&P 500 drop another 20%, or drop 20% from here. Let's just see these analysts come on TV and try to tell you the consumer's holding up and consumer spending strong. So, just keep that in mind, that consumer confidence, spending, they're lagging indicators. By the time you read about them, it's kind of dated information. It can change quick. All right, so got a couple more points to make here, and then we're going to dig into these charts and get a little bit granular here. Okay, let's do that. Let's zoom in here, and that's what I've done. This again is the Nasdaq 100 from October, beginning of October. I showed you the similarities up to that point. We can zoom in a little tighter, but what we're going to focus on, since I've already covered all that, is where we're at today. So here's what I've been highlighting recently, and I'm going to speak to this as if this was the current chart of the Nasdaq 100. Remember, this is when the market topped. This is when the Great Recession came, one of the strongest bear markets in history. That was the peak, and this is how it played out up until here. And I'm not showing you. I'll get to a chart in a second. It did this after that. The big drop, the primary wave 3 came. So up until then, up until recently, I was pointing out and saying that was the most bullish setup I'd seen in a while, and we had a big rally. Again, here it was 23% back then, but this time around it was about, what did I say, 17.5%, but comparable, and also both of them right to the about to the 61.8% Fibonacci retracement. So very, very similar. Then that rally was faded and then some, which is what I highlighted recently. We faded 100% and then some of the recent rally that we had. Now, again, I'll flip over to that chart in a second. I'll toggle between the two. And then at that point, I started talking about these divergences. And that's why I have a dotted line. Because back then, just like now, I keep using the word. And this is a term I made up. I've never seen it anywhere. Maybe other people might use it. But I call it potential divergence. When you have the indicators, which are, I'll have to scroll here, I have to zoom out to cover the RSI. The indicators, in which case I like to use the PPO and RSI, they're my go-to. When they're making higher highs, as they were back then, and prices are making lower lows, that's positive divergence. But to me, it's confirmed once you get the bullish crossover. And you can even see, just like then, we had the PPO starting to curl up. Hopefully you can see it in the video. Here, I can zoom in a little for you. You can see the PPO was curling up at that point, pointing up. So it made that turn where it looked like it was going to cross over. And just like now, we had a false break. We had a double bottom low. Again, this is just to me uncanny. We had a double bottom low in the Nasdaq that put in a major low, which was obviously being watched by everybody. If you use technical analysis, even if you're not, everyone watches major lows, right? So you had taken out that low. See that big red candle? But it proved to be a whipsaw. Guess what happened? Again, to me, it's uncanny. That occurred immediately in front of an FOMC meeting. We had right here, September 16th, that spike low was an FOMC meeting. And so the false breakout occurred, and I always say, don't read too much into breakouts that occur right in front of a market-moving FOMC meeting. Proved to be a false breakout. So just like then, I've been saying this recently, that on face value is very bullish. As I always say, there's fewer things in trading and investing that are more bullish than a failed breakdown. Why? Because two things happen. They call it a bear trap. Shorts pile in, and then they get squeezed out once they realize the breakout fails, which it did. And then bulls will pile in as well when they see that that support level actually held or was regained. So that was what happened back then. You can see this very long candle. I think you can see it. Again, I'm trying to zoom in here as best I can. This right here was Fed day. So went down. We had a huge reversal and a big rally the next day. So from low to high, that was again back then. The Fed came out, and they also, in that, what they did is they sat tight on rates. They kept the federal funds rate at 2%, no change. Similar to this meeting. Now, you might say, Randy, we just got a 50 basis point rate hike, the biggest one in a couple of years. No, that was 120% priced in. The market was almost an absolute certainty, and what I've told you guys before, Powell will not. The Fed of today does not surprise the market. They will not surprise the market. They don't do intermediate cuts. Maybe at one point they might have to, but it was almost a certainty. You could have put whatever amount of money you had on it, and that's what the federal funds futures were pricing in. And so, in other words, it was a non-event from that point of view. Now, the market took the overall statements and commentary from the Fed, especially when one of the reporters asked, would you consider a 75 basis point hike if necessary? And Powell completely dismissed that, said, no, we're not considering, we wouldn't do a 75. So the market took his comments as dovish. And yesterday we rallied. I'm going to get to that in a second, but this is exactly what happened then. But look what happened. We rallied up. We had, at that point in time, what looked to be, remember, don't look beyond this. If you can't see that, this is where we are today, or this was yesterday right now. I'm using that analog. They rallied it up, but then look at that hard fade after. And when they faded it, the fade kept going. And then guess what happened? We faded the entire FOMC rally. Then that came, and then let me just show you real quick what happened for those of you that weren't around back. Okay, this is it. This is that same chart from the 2007 high. This is that point I was focusing on right now. I had cut it down to about right here, but you can see the absolute bottom fell out. And this is what I've been talking about now for for quite some time is at what I call a POR, point of recognition. And again, the parallels up to this point to me are just nothing short of uncanny. I'm not trying to, be all dramatic about this stuff. Obviously, I'm a chart geek. I love this stuff. And again, something just didn't sit well with me last night. And so far, so good. And you can see what happened. The divergence, although it was there, it was potential, never got confirmed. And boom, the market dropped until we then put in a divergent low that was confirmed. And that's when the bear market was over. But that drop, just so you know, if you bought into that Fed rally at that point and thought, oof, the worst is over, the market fell 42% in just a matter of months from that point. 42% from there, and nearly straight down. There was one big bear market, a couple snapbacks, but that was powerful stuff. Okay, so once more, and then I guess this is where I'll wrap it up. I think I've made my point. That was then 2000, and at this point it was in 2008, and even the timing of it. Again, where the market peaked a month earlier, back in October versus November this time around, and played out a little longer. It got to this point, we're in September, we'll say that, but the price action, wave counts, all that kind of stuff comes into play, and that's where after that post FOMC rally, market was glad the Fed meeting was out of the way. Nothing big from them. They didn't disappoint. They did what's expected. They held tight. They did bail out AIG at that point. They announced a bailout for them, and got a 10% rally. And let me show you now where we're at today. Okay, this is today, and I made this chart up before the open today. That was so through the close yesterday. There's the similarities. There's the false breakdown that we had after the double bottom low. False breakdown occurred right before the Fed. There's that potential bullish development, bullish divergence that was forming. I'm going to zoom in here. You can see the PPO just like then curling up, but not yet confirming that divergence. Again, that's in my book. Confirmation comes when you make a bullish crossover. And when you make a bullish crossover, you've effectively put in a higher low. And so that's it. And if history repeats, and I'll tell you, today is certainly headed that way. Again, we had a 6.7% rally off the recent lows versus that one that was about 10%. And that's it. And then the divergences never failed to materialize. We took out the recent lows, and that powerful wave 3 came. One last chart to show you, and then I'll wrap it up, and I'll tell you why I think that is still very much a possibility. And of course, the takeaway is, look, as I like to say, support is support until less broken. So that's our recent low, but that's still a big level right about there. And again, this is the current chart right here. So, there's still the possibility that we could play out for a bigger rally. We could have a rally up to here. There's a reaction low. That's where that last one failed. See this reaction low right here? That'd give us about an 8.4% rally if that happened. This is the current chart of QQQ. And back then, that was NDX back then. See, it was a 10.6 rally, and it came to this previous reaction low right here, right about there. But one of the last charts I wanted to show you, and I've talked on this one for months now, even years. This is the CPCE, the put to call, equity only put to call ratio. So that measures the ratio of put buying to call buying only on stocks, not on the indexes. And as I've mentioned many times, I have a buy zone up here. This is where fear, when the CPCE spikes, and all the biggest drops. There was a last bear market down here, right? That ended with a big spike. We had during the bear market, we spiked up into that area. And right here, we had another big correction, 21%. We hit that level. In other words, this is where fear comes in. During a correction, when there's a lot of fear, there's a lot of put protection. Investors, both institutional and individuals, run out and they buy put protection. That helps to put a floor into the market because they're protected. There. You had it right there. The big fourth quarter drop of 2018 ended with a surge. COVID ended with a surge up to the green level. This time around, it didn't happen. Again, guys, this is a common theme I'm seeing. There's just no fear in this market. There's not enough fear. Yeah, you got a little spike here. And remember, I also showed you that likewise, where excessive fear is what usually ends a correction, or at least temporarily or permanently. But you also have a drop. I use that 100 period moving average on the CPCE weekly. And when we hit this red line, there is a lag, but the top has always come. We hit it there. There was the lag. There was the end of the bull market and the beginning of a 57% bear. We hit the line here. There was a lag and then a 21%, 22% drop. We hit it there. There was a lag, 16% drop at that point. We hit it here. Nothing. Not only nothing, this 100-day moving average has gone way below that level, showing excessive pessimism. I'm sorry, excessive bullishness. Lack of fear, and the piper hasn't been paid yet. So there it is, guys. A lot of stuff. We'll see how it plays out. And again, the takeaway, like I said, is history doesn't always repeat, but it often rhymes. And so just don't be in denial. I know, again, I listen to others, and I respect everyone's got a good point of view that may not play out. Mine as well. The thing is to react and pivot. Don't get married to your views. If this happens, do not underestimate how far and how fast the market can fall just because you're being told that the economy has a very strong underpinning right now, that the consumer is spending. One of the things out there, very few saw 2007 coming. I saw it. I talked about back then. I profited tremendously in that bear market, and both on the downside and the rallies. Going long. I used to work for bank brokerage programs, and I was in with the banks and with the officers. I knew what was going on with the lending. I knew there was a huge bubble on Wall Street, and it unwound. Now, what may happen at this point in time, something that I'm not hearing many talk about, is a blow up in hedge funds, pension funds. We have seen, you've probably read the headlines, we've had the worst start to a quarter in I don't know how long, with both treasury bonds, this is TLT, treasury bonds plummeting, as well as stocks in the first quarter of the year so far, and up to where we're at now. This blows up the old 60-40 rule. There's a lot of balanced funds out there. And again, being an old ex-financial advisor, it's asset allocation 101. Typically the older you are, the more you're going to have in bonds. Take the number 100 minus your age, less into stocks. But a balanced fund, and where many pension funds run, give or take, is the old 60-40 mix, where they'll have 60% equities, again, less if they're less aggressive, and then 40% into bonds, right? And because at almost all points in time, when the stock market drops, bonds go up. And I'm not talking day to day, I'm talking the trends. That has worked throughout the financial markets. That is broken. And you talk about, pension funds that are already and have been for years now grossly underfunded, trying to play a game of catch up, and they made some headway recently. That's been wiped out. So if you want to know what may be the next black swan event, that may be it. A big fund, a financial institution with a lot of leverage, any of that. There are risks out there that I think are not being talked about. I don't hear much of that. And sometimes it's the risks you don't know about, you or I don't know about. So anywho, react. That's all I'm trying to say. You can be proactive or reactive at this point in time. Up to you. If you really think that's going to happen, you be proactive and you start scaling into or hold on to your shorts if you have shorts already, or add to them. And if you're a bull and you think this is going to happen, or you're a bear, you have to react. If they bulls hold the line here, that analog that I just laid out, it may not play out that way again. History doesn't always repeat. It often rhymes, but not always. So that's it. It's simple stuff, guys. I think there you have it. I would. What I'm getting at is I think you can short and throw away the key, of course, with a stop in place, but just let it go trail down if we break these recent lows. If all this bullish action we had over the last week or so, not even week, few days, gets taken out. Again, to me, it's still D-Day or D-Week. and we'll know. Again, I told you I wouldn't cover another chart. Subscribers, I've showed you the 20-month moving average, which has been taken out on a monthly closing basis by QQQ, and SPY closed right on it last month. So if we take out these lows and we have a bad month, we're going to trigger additional sell signals, trend indicators on the longer term charts that will flip from bullish to bearish. We still have a few that are holding out, still bullish. That's why you can't write this market off yet. But again, it's the trend is just one after another. We're making a series of lower lows and lower highs in the market. And so we take out these lows. At some point, we're going to have that waterfall type selling. And that's where if you wait too long, you're going to miss a good part of it. And that means to either get in short or to get out of your long. So that's it. And if you're long and you went long here and you pivoted recently, we're still above the lows. Just keep your stop in place and let it ride. And you might get a test of the 200s. You might even break the 200s. You might even go on to new highs. Anything is possible. Flexible. Be flexible as a trader. Alrighty, guys. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.